Is Qualcomm a once-in-a-generation buy or a ticking time bomb? What if I told you one of tech's biggest giants is at a crossroads where it could either redefine the future of AI and electric cars or fall off a financial cliff? Star investor Cathie Wood certainly thinks it's a winner she's been buying up the stock, but the bears are screaming, pointing to a perfect storm of risks. So, who is right? And could Qualcomm be the next hidden treasure hiding in plain sight? That's the billion-dollar question we're here to answer. We believe the best way to find the truth is through the fire of debate to see if this stock is truly the next big thing or a value trap in disguise. Let's get straight into it.
Ladies and gentlemen, everyone, let me share why Qualcomm is not just a great investment today, but why its future potential makes it even more exciting, and I'll keep it simple and clear. First, what does Qualcomm do? Qualcomm designs the chips that power our phones, cars, and smart devices, letting them connect to wireless networks. It also licenses its technology to other companies. Think of it like renting out blueprints. In 2024, Qualcomm made about $33 billion from selling chips and $5.6 billion from licensing. Now, let's talk about why Qualcomm's future looks so bright. Qualcomm's chips are driving the next tech revolution in cars. From electric vehicles to self-driving features, their technology is becoming the brain of tomorrow's cars. In the last quarter alone, automotive chip sales jumped 59%. By 2029, they're aiming for $8 billion in car chip revenue, like adding a whole new business on top of their phone chips. As cars get smarter and more connected, Qualcomm's technology will be inside millions of vehicles, making driving safer and more enjoyable. Beyond cars, Qualcomm's advanced chips are powering a new generation of robots. These aren't just any robots. They're the smart machines working in factories, warehouses, and even hospitals. With powerful AI and 5G connectivity, Qualcomm's platforms help robots see, think, and communicate in real time. As more industries use robots for automation and efficiency, Qualcomm stands to benefit from every new robot built with its technology. Qualcomm is also leading the next wave of personal computing. Their Snapdragon chips are now inside a new breed of AI-powered laptops and PCs. These computers are faster, smarter, and more energy efficient, offering features like instant language translation, advanced video calls, and real-time security. Over 85 new laptop designs are in the works, all powered by Qualcomm's technology, leading the shift to AI-driven personal computing. But it doesn't stop there. Qualcomm is a leader in bringing AI to the edge, meaning their chips let AI run directly on devices, not just in the cloud. This gives us faster, more private, and more reliable AI features in everything from smartphones to cars to smart home devices. And even with all this future growth, Qualcomm is financially solid. Last year, they generated $11 billion in free cash flow and plan to return all of it to shareholders through dividends and buybacks. The company trades at a reasonable price, making it attractive for long-term investors. In summary, Qualcomm isn't just the engine behind today's smartphones. It's becoming the backbone of tomorrow's cars, robots, and AI-powered computers. With strong financials, market leadership, and a clear path to future growth, Qualcomm is a smart buy for anyone looking to invest in the next decade of technology. Thank you.
Ladies and gentlemen, distinguished judges, let me cut through the rosy projections and give you the hard facts about why Qualcomm is facing a financial cliff that no amount of diversification can save it from. My opponent painted a beautiful picture of cars and robots, but here's what they conveniently ignored. Qualcomm is about to lose $7 billion in annual revenue when Apple completes its exit by 2028. That's not speculation, that's Apple's stated timeline with their C1 modem already deployed. To put this in perspective, that's nearly 20% of Qualcomm's entire revenue disappearing overnight. But the crisis runs deeper. China represents 46% of Qualcomm's revenue, that's $17.8 billion at risk in an escalating trade war. While my opponent talks about future growth, Qualcomm's current quarter guidance of $10.3 billion already fell short of Wall Street's $10.33 billion expectations. The company's own CFO admitted their guidance reflects current assessment of financial impact from tariffs. Here's the math that doesn't lie. MediaTek has already overtaken Qualcomm in 5G smartphones, capturing 29.2% market share, while Qualcomm dropped to 26.5%. MediaTek's shipments grew 53% while Qualcomm's remained flat. This isn't future competition, this is present reality. And that licensing goldmine? Qualcomm's QTL segment revenue fell short of estimates and shows only 2% expected growth. This high-margin business that contributes 36% of total earnings is weakening just when Qualcomm needs it most. The stock tells the story, down 30% from its highs, with recent earnings beats followed by immediate sell-offs because investors see through the guidance disappointments. The verdict is clear. Qualcomm faces a perfect storm of losing its biggest customer, operating in a hostile geopolitical environment, and falling behind competitors, all while their guidance consistently disappoints. This isn't about future potential, it's about present financial reality.
Thank you for that passionate opening, but let me address those concerns with some crucial facts you've overlooked. First, let's talk about the Apple situation. Yes, Apple is transitioning to in-house modems, but this isn't the financial cliff you're describing. My opponent wants you to believe Qualcomm is sitting idle, watching $7 billion disappear. The reality? Qualcomm has been preparing for this transition for years. By 2029, their diversification strategy targets $22 billion in non-handset revenue. That's 3 times more than what they'll lose from Apple. The numbers tell a compelling story. Automotive revenue just surged 59% year-over-year to $959 million, and they're on track to hit $8 billion in automotive revenue by 2029. IoT revenue grew 27% to $1.58 billion, with the industrial segment leading the charge as companies transition from basic microcontrollers to AI-powered processors. This isn't just growth, it's explosive, sustainable growth in markets that dwarf smartphones. Now, about MediaTek overtaking Qualcomm, let's get the facts straight. MediaTek leads in low-end phones under $250, while Qualcomm dominates the premium segment where the real profits are. MediaTek's 29.2% share comes from budget devices with razor-thin margins. Meanwhile, Qualcomm maintains a 52% revenue share in smartphone modems, revenue share, not unit share, because they command premium pricing for superior technology. The China exposure concern? Qualcomm generates 46% of revenue from China, but here's what's important. They're not just selling to China, they're powering China's digital transformation. Chinese manufacturers depend on Qualcomm's cutting-edge technology to compete globally. This isn't a weakness, it's a competitive advantage in the world's largest semiconductor market. As for guidance, yes, Q3 came in slightly below expectations, but Qualcomm still posted 15% year-over-year growth and beat earnings expectations. The company is being appropriately cautious given trade uncertainties, but they're still growing faster than most tech companies. The real story here isn't about short-term headwinds, it's about a company that's successfully diversifying into the fastest-growing tech sectors. While others talk about the future, Qualcomm is already there, powering the cars, robots, and AI devices that will define the next decade. That's why Qualcomm remains a buy. Thank you.
Ladies and gentlemen, my opponent just gave you a masterclass in wishful thinking. Let me break down why their rosy projections crumble under basic math. First, that $22 billion diversification target by 2029? That's 4 years away, but Apple's revenue cliff hits in 2027 to 2028. Even if, and that's a big if, Qualcomm hits every single growth target, they're still facing 2 brutal years of declining revenue while scrambling to replace Apple's $7.8 billion. That's like losing your biggest client and promising your investors, "Don't worry, we'll find new customers, eventually." Second, let's talk real numbers about that automotive surge. Yes, 59% growth sounds impressive until you realize it's only $959 million. To reach their $8 billion target, they need to grow automotive revenue by 734% in 4 years. That's not growth, that's pure fantasy. The entire automotive semiconductor market is only $71 billion globally. Good luck with that when they're competing against established players like NXP and Infineon. Third, About that China advantage, my opponent just proved my point. When 46% of your revenue depends on a single country that's actively developing domestic alternatives and faces escalating trade tensions, that's called concentration risk, not competitive advantage. China's semiconductor self-sufficiency program specifically targets reducing dependence on companies like Qualcomm. Here's the killer fact my opponent ignored. Qualcomm's operating margins have been in a troubling 5-year decline, with an average decline rate of 3.9% per year. While they're chasing low-margin automotive and IoT markets, they're losing their high-margin smartphone dominance. That's not diversification, that's dilution. The bottom line, Qualcomm is asking you to bet on a company losing its most profitable customer, operating in a hostile geopolitical environment, and promising unrealistic growth targets in competitive markets. Don't fall for the hype. The numbers don't lie. Qualcomm is not a buy.
Ladies and gentlemen, thank you for listening to this debate. Let me leave you with the real reason why Qualcomm remains a smart buy despite my opponent's doom and gloom predictions. First, let's get the Apple timeline right. My opponent wants you to believe there's a sudden revenue cliff in 2027. That's simply not how business works. Apple's transition is gradual, not overnight. Qualcomm will continue earning revenue from Apple throughout this transition, and they're already replacing that business with higher growth sectors. This isn't a crisis, it's a planned evolution that smart companies make. Second, about those automotive numbers. Yes, growing from $959 million to $8 billion is ambitious, but here's what my opponent missed. Qualcomm isn't just chasing one market. They're winning in automotive, robots, AI, PCs, IoT, and data centers simultaneously. When you're the technology leader in multiple booming sectors, those numbers become very achievable. Third, the China risk argument. My opponent sees a glass half empty, where I see opportunity. China is the world's largest semiconductor market, and Qualcomm's presence there isn't weakness. It's proof they build technology the world's fastest-growing economy depends on. That's exactly where you want your investments. Here's what really matters. While my opponent focuses on yesterday's challenges, successful investors look at tomorrow's opportunities. Qualcomm is positioned at the center of every major technology trend reshaping our world: 5G, AI, electric vehicles, smart cities, and industrial automation. The financial reality? Qualcomm just delivered 15% revenue growth, 17% earnings growth, and $11 billion in free cash flow. They're returning 100% of that cash to shareholders while still investing billions in the future. That's not a company in trouble, that's a company in transition to something much bigger. My final point. Every great investment requires seeing beyond today's headlines to tomorrow's possibilities. Amazon wasn't profitable for years, but smart investors saw the future. Tesla faced constant skepticism, but believers were rewarded. Qualcomm is that opportunity today, a profitable, cash-generating leader positioned for the next decade of growth. Don't let fear of short-term uncertainty blind you to long-term opportunity. Qualcomm is a buy because the future needs exactly what they build. Thank you.
Ladies and gentlemen, thanks for sticking with us. My opponent talks big about future wins, but let's face it, the numbers show Qualcomm is heading for trouble, not triumph. First, that Apple gradual transition? It's still a massive hit, losing up to $7.8 billion a year by 2028. No amount of slow fade changes the fact that 20% of revenue vanishes, and their diversification won't plug that hole fast enough. Second, automotive dreams? Jumping from under $1 billion to $8 billion sounds great, but it's a huge stretch against tough competitors, and the global market isn't big enough for that kind of grab without real proof. Third, China as an opportunity? With 46% of revenue tied there amid trade wars and local rivals pushing hard, it's a massive risk, not a safe bet. Bottom line, Qualcomm's facing customer losses, fierce competition, and shaky finances. Don't bet on hype, bet on facts. Qualcomm is not a buy. Thank you.
All right, over to you, the judges. What do you all think? I'm looking forward to seeing your votes and thoughts in the comments section. We love hearing what you have to say, and I believe every perspective brings something valuable to the table. Also, I've done my best to fact-check the information you've just heard, and you can find the relevant links in the description box below. Before you go, don't forget to hit that like button and subscribe. Your support means the world to us. We'll see you next time. Bye-bye.